Every investor starts out with the exact same impossible goal. We want to grow our wealth as fast as possible, but we want absolutely zero chance of losing any of our money. The natural instinct is to take the conservative route. Keep everything in cash, put it in a standard savings account, and lock it away where market crashes can't touch it. But avoiding the stock market doesn't mean you avoid risk. It just introduces you to inflation risk, the invisible penalty for playing it safe. This chart shows what happens to a 10,000-pound stack of cash over a 10-year timeline. Even with a moderate inflation rate of around 3.2%, the purchasing power of that cash takes a steady drop every single year. A stock market crash makes headlines and causes immediate panic. The erosion of cash happens silently in the background, without a single red arrow flashing on a screen. You aren't eliminating risk by staying in cash. You are simply trading the possibility of a temporary market drop for the mathematical certainty that your money will buy less in the future. Investing, then, is a transaction. You are purchasing long-term growth, and the currency you pay with is short-term volatility. The real question is how much volatility you can actually afford to endure. Financial advisors use a 1 to 10 investment risk scale to diagnose exactly that. Looking at this risk scale document, the lower levels, 1 through 4, prioritize capital protection over high returns. But as you move higher toward levels 7, 8, and 9, the text warns of significant and rapid fluctuations in value. That turbulence is the exact mechanism that generates wealth. The extra return you see at the top of the scale is quite literally the financial compensation you receive for not panicking during a drop. Let's map out what these profiles actually look like in practice, starting with the low-risk bracket, covering levels 1 through 4. This portfolio is heavily weighted toward cash deposits and stable government bonds, keeping exposure to the stock market to an absolute minimum. The result is a highly defensive position. Your capital is shielded from major market shocks, but your growth potential is severely capped, often struggling to even keep pace with inflation over a decade. Look at this low-risk chart showing performance during the 2008 financial crisis. Even during one of the worst economic meltdowns in history, a portfolio with 25% exposure to the FTSE index experienced a drop of just 5.1%. It acts perfectly as a wealth preserver. By limiting the damage to 5%, it successfully prevents the investor from making an emotional decision to sell at the bottom. Stepping up to levels 5 and 6 brings us to the medium risk profile, designed for those who can stomach some turbulence to achieve real growth. The strategy here relies heavily on asset allocation, typically a balanced 50-50 split between equities to drive growth and bonds to maintain stability. They work as a counterweight to one another. When a recession hits and equities fall in value, the bond portion of the portfolio acts as a shock absorber. Looking at the center medium risk chart, we see the true cost of extra growth. This balanced portfolio dropped 14.9%, nearly triple the drawdown of the conservative portfolio. Investors watched a large portion of their wealth vanish on paper. The moderate optimizer accepts this reality. They forfeit the massive windfalls of an aggressive strategy to ensure their portfolio can survive recessions while reliably beating inflation over time. Finally, we reach the high-risk, adventurous profiles found at levels 7 through 10, built almost entirely of equities. Over a multi-decade timeline, mathematics and historical data heavily favor this allocation for maximum wealth accumulation. But living through the volatility required to earn those returns is a deeply stressful, visceral experience. We can see this starkly in the high-risk chart. During the financial crisis, a portfolio heavily weighted in the FTSE 100 plunged by 28.2%. Building your portfolio comes down to a strict prioritization exercise. You cannot engineer a strategy that provides both total capital protection and aggressive growth. Identify your primary priority. To protect capital, you belong in levels 1 through 4, relying on cash and bonds. To beat inflation with a safety net, the middle tiers provide a balanced split. For maximum growth, levels 9 and 10 require a heavy equity allocation. Successful investing isn't about guessing which stock will spike next. It is the deliberate process of mapping your personal psychology to mathematical probabilities. The cardinal rule of asset allocation: never adopt a risk profile in a calm bull market that you cannot maintain in a vicious bear market. You simply have to choose your preferred pain up front. You can either accept the slow, steady erosion of inflation, Or you can face the violent, temporary swings of the stock market. Knowing your identity as an investor allows you to set your allocation, let the math work over decades, and completely ignore the noise along the way.